Now, on most occasions, the market will test candlestick formations. For bullish candlestick patterns, the bears will test the lows for selling interest. If there's no selling interest, the pattern would hold and prices will rally. Now, if it's a bearish candlestick pattern, the bulls will test the highs for buying interest. If there is no buying interest, the pattern will hold and prices will fall. So this is the reason stop loss orders have to be placed above the highs and below the lows of candlestick patterns. Okay, so the market will on several occasions test candlestick patterns. This is something that you should know and something that you should trade expecting. You should trade expecting the market to test the candlestick pattern. So here we have an example. So here we have tweezer bottoms. Now, say for example, you saw these tweezer bottoms and you bought the market. So you would buy the market after seeing the tweezer bottom. So you would have entered the market around this price. Okay. Now you enter the market and the market begins to rally. And then the market begins to test the candlestick pattern. You see how much times the market tests the candlestick patterns here? We see the first test, second test, third test. So on several occasions, the market tests these tweezer bottoms. And then we see the market rally. So always remember and always trade expecting the market to test the candlestick pattern. So this is why if you're buying these tweezer bottoms, your stop loss order has to be below the wick of the tweezer bottom. Now, do not trade candlestick formations in consolidation. This is extremely important as on several occasions you will get fake signals inside consolidations. Now, trade candlestick formations in the direction of the trend after a retracement. Trade candlestick formations at Fibonacci levels and at trendline bounces. When trading candlestick formations, ensure that stops are placed couple pips above the formation when selling and couple pips below the formation when buying. One of the main rules to trading is if the risk of the trade is too much, do not take the risk. And this is extremely important. Successful traders become successful not just because of how much they make, but because of how much they do not lose. Now, candlestick formations allow you to have very little risk on the trade. So remember, keep your losses small and let your profits run. So here we have an example. Here we have an uptrend. The market pulled back or retraces and we get a candlestick pattern. Okay, so uptrend, market retraces, and we get a candlestick pattern. Here we have an engulfing bullish candle, and as a result the market rallied. So if you had bought this engulfing bullish candle and placed your stop below these lows, you would have made a lot of money. Okay, so candlestick patterns can be extremely powerful when used along with the trend. Now, did you learn what are Japanese candlesticks? How to analyze trading charts through the use of Japanese candlesticks? Did you learn how to identify the various types of Japanese candlesticks? Did you learn how to trade Japanese candlesticks? And did you learn that Japanese candlesticks often indicate potential turning points in the market? So if the answer to all of these questions is not yes, go back through these lectures again.